Hey guys, welcome back. In today's video, I want to walk you through some of my favorite option spreads for swing trading. These are some very popular spreads that I think when people are new to options often get confused because it can be a little bit confusing when you're just getting started as far as understanding how these spreads are structured, how they make money, and how you can put these trades on. So I'm going to actually demonstrate this in a visual manner using technical charts that I think most of us are very familiar with, so you can visually see how these spreads are structured, how they make money. And again, I'm going to walk you through how you can set up these trades using the Tastyworks platform. So if you guys are new here, I'm Tex and I share my journey with trading and investing in the stock market. As always guys, I really appreciate you watching. Let's go ahead and roll the intro and get started with the video. Alright guys, so jumping in here, let's start out first and foremost with vertical spreads. That is going to be the foundational building block for every other type of strategy we're going to talk about in this video. In fact, you're going to see that all the other strategies is just simply a combination of vertical spreads. So let's first understand a vertical spread and how they're structured, and we'll look at how to put them on in the Tastyworks platform. Now, let's use the technical chart here to visualize this first and foremost. So you essentially have two different categories of vertical spreads. You have debit spreads and you have credit spreads. So a debit spread is where you're actually paying money out of your account to put the trade on, and a credit spread is where you actually receive money into your account for putting the trade on. So you're looking to accomplish really two different things with those spreads. A debit spread, you're looking for a directional move and an underlying. So for example, in this case of Facebook, if we're directionally bullish on Facebook and we think that Facebook is going to make this move back up to the all-time high after it has broke above this previous swing high here, it's pulled back into it. If we see this hold support, we think Facebook's going to make a move up here. We can put on a directional bet by putting on a debit spread, and in this case we would call this a call debit spread. This means that we're buying calls because it is a debit trade. We're buying calls, but we're structuring it into a spread which combines also shorting calls at the same time. So as we know, if we're just trading naked contracts, if we are bullish on the underlying and we buy calls, they're going to appreciate in value if the underlying trades higher. The downside to doing naked calls though is that it's a lot more expensive than if you structure it into a spread. The upside is that there's unlimited profit potential. If we buy naked calls and Facebook really goes up higher, we can make a boatload of money. There's really no limit to how much money we can make with those naked calls. But again, it's going to involve more risk because it's going to be more expensive. So if we wanted to put on a directional bet, in this case, we think Facebook's going to go higher. What we could do as an example is come in and say buy a call here at the 320 strike price. So we buy one call there, and then maybe we come up to the 330 strike price here, and we would actually short one call. Okay, so you're buying one call here, and you're shorting another call further away out of the money, and that creates your spread. Right here is the spread. This is why it's called a vertical spread, because it's a spread that's vertical between a call that you're long and a call that you're short. Now the spread actually makes money if Facebook trades higher. Now here's the catch. Because we bought those calls, we have theta, which is time decay, working against us. So we need Facebook to make this move relatively quickly in order for the trade to make money. If Facebook just kind of trades sideways like this and kind of slowly works its way up there, it can be more difficult to make money with a spread like this. So always something to consider with debit spreads is that they're really good for a strong directional bias on a stock, but they're really bad if you're not really convinced that the stock's going to make that move fast enough. So in that case, a credit spread might actually be better. But before we jump into credit spreads, let me just show you the inverse of this. So we just did a call debit spread. Let's say that we're actually bearish on the underlying. We think that Facebook's going to fall back below this 316 level and maybe even come all the way back down here to 300, right? So in this case, we're going to buy puts. We buy puts if we're bearish. So maybe we come in and we say we buy a 315 put here. So we buy one put there. And then we come in to a lower strike price, say 300 here, which is where we think it's going to go, and we short a put there. So here is our vertical spread. Of course, if we're right and Facebook makes this move lower, this spread will make us money. If we're wrong and Facebook just kind of trades here and doesn't really make the move we're looking for, we lose money, okay? Now, when we're talking about credit spreads, obviously we're going to have multiple ways to profit because as I said, with debit spreads, we really need that stock or that underlying asset to make that directional move. With credit spreads, let's say that we're bullish on Facebook, but we don't know if it's really going to make this move up to the all-time high. We think that there's a chance it could, but there's also a chance it's just kind of trade sideways, right? So how can we set up a trade here to profit? Well, what we could do is we could come in and look at the support level here around 300, say we think that support level is pretty secure. So maybe what we do is we come in and we short one 300 put, right? We short one put at that 300 strike price, and then we come in below that for protection to that 295 strike price, and we buy one put there. All right, so in this case, because we're a net seller, because the credit we're going to collect for selling this 300 put is going to be more than the debit we're going to have to pay out to buy this 295 put, because the 295 put is further out of the money, so it's going to be cheaper than the 300 put. That means that we're going to be a net seller. We're going to have a credit to put this trade on. And in this particular case, the beautiful thing about this is that as long as Facebook stays above our short strike here at 300, it doesn't matter where, as long as it stays anywhere above that short strike. If it goes sideways or if it really rips and takes off, either one of those situations, we make money. Okay, that's the beautiful thing about a credit spread, is because that theta, that time decay, is your friend. Every day that passes, that credit spread is going to make a little bit of money, right? So that's a beautiful thing about a credit spread, and a great way to put on a trade that will obviously give you profit directionally if you're right in the direction, but also by time. If you're wrong on the timing, you still make money. So it's a great trade, and that is what we would call a put credit spread, and that would be when we're bullish on the underlying. Obviously, the inverse of that would be a call credit spread if we're bearish on the underlying. Let's say that we think this all-time high here is secure, so maybe we come in and we short one call here at that 330 strike, and then for protection, maybe we come up to the 335 strike there and we buy one call there. So just in case we're entirely wrong and Facebook trades through our entire spread, we cap off our risk, right? We will have a max loss, which your max loss is essentially calculated by the spread distance here minus the credit you received. The platform's going to do all that math for you, so I'm not going to really confuse you with all that, but just so you know, it's always calculated by the width of the spread minus the credit you received, and that's going to tell you what your max loss on the trade is. In this case, obviously, it's the same thing in inverse. We just want Facebook to stay somewhere underneath of our short strike here at 330. Doesn't matter where, as long as it's below it, we make money on that trade. So let's hop into the Tastyworks platform and look at some specific examples of how you can set up both debit spreads and credit spreads. Okay, so again, looking at Facebook here, let's do a debit spread first. And when we're looking at the chart, let's go with the thesis that we have a strong directional bias on Facebook. We think it's going to make a move back up to that all-time high around $330. So let's look at putting on a call debit spread, which means we're bullish. And you look at your expiration cycle here on your option chain. For debit spreads, you're going to want to give yourself a little bit of time, probably at least 2 weeks. And I'll show you why in a little bit, but let's see if we come to this 13 days till expiration cycle here, expand that out, and we come here and we can see where the current price of Facebook is. This brown line here is indicating this. We have calls over here on the left, of course, puts on the right. We can see that the calls up here are in the money and the puts down here are in the money. Now, because we are targeting that all-time high and Facebook is currently trading around 316.23, let's say that we want to come in and buy a 320 call and short a 330 call to complete our call debit spread as we did in the example before. We come to our option chain here and you can see that here's the 320 strike. If I come in and just buy a single call at that 320 strike, it's trading for $4.80. So of course we do the option multiplier of 100. That means that it's going to cost us $480 to put this trade on to just buy that single call. That of course is our max loss. That's the most we could lose on this trade, is whatever we paid to buy that call. That naked call on its own is going to have an unlimited profit potential. So that's a great thing. However, it is going to be more expensive than if we structure it as a vertical spread. So if we come in and look at that 330 strike where we wanted to short a call, you can see that that is trading for $1.55. So if we sell that, we're going to be bringing in $155 of credit, but we are paying out we're paying out $480 to buy that call here. So the difference is $299. So we reduced the cost to put this trade on from $480 to $299 by structuring it as a vertical spread. Now you can see, of course, our max loss is what we paid to put the trade on there, $299. But now we have a max profit. Instead of our max profit being unlimited, our max profit is $701. And that would occur if we held this trade to expiration and Facebook closed anywhere above $330. So if we were right and Facebook trades over the all-time high and it closes over that strike price, that 330 strike price when it expires, we would realize max profit on the trade. But debit spreads are incredibly difficult to get max profit on, and you'll pretty much never hold one to expiration. A good kind of target to shoot for is a 50% capture rate. So if you can capture 50% of this max profit, that's a really good trade for a debit spread. So that's just kind of an example of what you're looking at when you put on a debit spread and how you're going to have that max profit that is capped. Now, some of the other metrics that we're looking at over here, beginning on the left side, you can see that this trade has a 33% probability of profit. This is telling us it has a 33% probability of making at least 1 penny at expiration. So obviously that's a really low probability of profit. With trading, there's always give and take. We have a pretty decent risk reward here, about, better than 2 to 1, $300 max loss for the potential to make 700, but we know we're not going to capture that entire max profit. So on paper, it does have a better risk reward, but you're not going to capture that whole profit potential. And then when you look at your probability profit, it's really low, right? So if you have a better risk reward, you're always going to have a lower probability profit. If you have a higher probability profit, your risk reward is going to be more skewed. You're going to be risking more than you can make. Okay, so it's always give and take. Some of the other metrics you see here, this is the extrinsic value of the spread. We know that with option contracts, the contracts that are in the money have intrinsic value, and contracts that are out of the money only have extrinsic value. And extrinsic value is defined by theta, which is the time in those option contracts until they expire, and vega, which is the amount of volatility those contracts have in them. And so those two factors really make up the extrinsic value of options. And any options that expire out of the money they're going to lose all of that extrinsic value when they expire. And you can see that this spread right here, because we're buying a call here that's out of the money and we're selling another call here that's out of the money, it only has extrinsic value in it, right? It only whenever if the price of Facebook were to trade higher to say 325, then this 320 call would go in the money and it would actually have intrinsic value. But as it is now, both of these are out of the money, so they only have extrinsic value. So of course we see that the extrinsic value is the same price as what we're paying to put the spread on, $299. And if we're totally wrong on the trade and Facebook closes below 320 at expiration, then all of this extrinsic comes out of the spread and we lose the entire amount of money that we paid out to put the trade on. Here you have P50, so this is the probability of capturing a 50% profit on the trade. It's 56%. You're looking at about 50-50 in this case, whether the trader works or not. Your delta is telling you how much the spread is going to gain or lose value with each $1 move in the underlying. So for example, we see Facebook is last price with $316.23. So if we had this trade on right now like this, and Facebook traded up to $317.23, so it moved up by 1 point, this spread would increase in value by $22.19. Likewise, if Facebook drops 1 point, the spread is going to lose $22.19. Now we see the theta number here. You can see it's -7. So this is telling us how much this spread is going to lose just from the passage of 1 day. So remember, When you open a debit spread, theta is your enemy. It is working against you. Every single day that passes, this spread is going to lose $7 in value. So we really need to be right directionally and by time for Facebook to make this move we're looking for, to compensate for the amount of theta we're going to lose from just the passage of days. And we can't do anything about that. And so that's really it. That's the metrics we're looking at here. This is how you would structure that trade as we were looking at on Facebook. For the bearish scenario, again, if you were thinking that Facebook's going to fall back down here to that 300 price level, we would just simply do it with puts instead of calls, right? So you can actually just grab this long call here at 320. Again, looking at the chart, I think we talked about doing the 315 put. So we're going to go long a 315 put and then go short a 300 put. So we got go back over here, grab this and move it over to the put side, and we'll go to the 315 strike, and then we'll grab the short and move it over here to the put side into the 300 strike. All right, so there you go. We are long one 315 put, which is just out of the money, and we are short one 300 put that's a 15-point wide spread. It's a pretty wide spread there. You can see that our max loss is $370, so it's going to cost us $370 to put the trade on. Max profit $1,130, so really good risk reward on the trade, and that's really because we have such a wide spread here. I'll show you that in just a moment. You can see the theta is $5.50. The delta is $29.08. We have a 48% probability of capturing 50%. So as you can see, with this wide spread, it has a really good risk reward. Look what happens if I bring in my short strike to 310. So now we have a really narrow spread. You can see that it's a lot cheaper to put the trade on. It was $370 here to put the trade on. If we narrow the spread, it's only $158. Of course, our max profit potential has come down as well. But another thing you can see is that the theta is lower. Look at the theta here is less than $1, where up here it's $5.50. So the wider you make this spread, the more the theta is going to be. So something to consider: if you go with a more narrow spread, the theta is going to be less. So too will your delta, right? The spread is going to make more money on a directional move if you widen it out. Your delta is a lot higher, so the spread is going to make $29 for every 1 point move in the underlying in favor of our spread, versus if you do a narrow spread, it's only going to be $11.86. You do have a 56% probability of 50% capture there with a more narrow spread in this particular case. All right, so that is your debit put spread. Now let's take a look at credit spreads and when we might actually use that. So let's go back to our chart here, and for this I'm going to use the S&P 500 as an example. So we can see that the S&P 500 has an all-time high up here around 4240 or so, and it has this pullback low here around 4060. So for credit spreads, let's say, for example, that we feel pretty secure that this low here around 40, what is that, about 4050 or so, we feel that low is secure. We don't think the S&P 500 is going to break that. So if we wanted to come in and sell a spread down here that would make money as long as the S&P stays above that, what we could do is come in and look at that 4050 strike price on the put side. So we go back to Tastyworks and let's load up SPX. And let's go to an expiration that's just 6 days out. So these expire at the end of the following week here. And we go to our put side and we come down, and you can see that here's that 4050 right here. So that 4050 is that support level we're looking at. And then what I want to point out is looking at the delta. Okay, so when you're talking about selling credit for credit spreads, I always want to look at the delta. In fact, a lot of times what I'll do is I'll come into Tastyworks before I even look at the technical chart, and I'll look at where the delta is and see exactly where I could sell some credit here. And ideally, I want to look at something that has about a 15 delta. So you can see that right here, the 4045 and the 4040 both have 15 deltas. So let's say we go with this 4040 strike and we come in and we sell a contract there, and that is right at that 15 delta. So what we can use this delta for is essentially telling us the probability that this 4040 put here is going to expire in the money. So with a 15 delta, there is only a 15% chance that this 40/40 put will expire in the money. So essentially, there's a 15% chance that the S&P 500 will close below 40/40, right? So there's only a 15% chance that the S&P 500 will close below that level when these contracts expire in 6 days. Okay, now we can look at the option chain here. You see this brown shaded area in the middle. What this is telling us is the expected move over the 6 days for the underlying, in this case, the S&P 500. So for the next 6 days, the expected move to the downside is about 40.90 and to the upside is 42.20. Now, this isn't perfect. Obviously, these stocks can move way more than that, but this just gives you an idea of where the expected move is based on implied volatility over the next 6 days. So you can see by coming way far out here, we're way outside of that expected move. This is your 1 standard deviation here. So we're even outside of the 1 standard deviation. And you can see we can get that far away with a 15 delta, and that gives us a really high probability of profit trade. Now we would come in for a protective side here. You can see that we would be collecting $880 for selling that 40/40 put. We come in for protection and maybe buy the 40/30 put for $820. So that gives us a net credit of $95. So you can see our max profit on this trade is only $95. But our max loss is $905, right? So that's huge. However, if you do the math on this, if you capture this entire max profit, you're looking at a return on capital closer to 10%. So, it's like 8 something percent. When you're talking about doing a trade that only lasts 6 days for an 8% return on your money, that's a really good return on your money. But again, we talk about that risk reward and that give and take. Huge risk for a smaller reward, but look at your probability of profit, 90% probability of profit. And you even have an 89% probability of capturing just 50% of this. Okay, so you have a very high probability trade that, of course, gives up some of that risk reward side. Again, we look at some of our metrics down here. We see that the delta here is $1.45, but we also look at the theta. In this case, because we are selling a credit spread, theta is our friend, right? So in this case, if we did nothing, this spread, or if the underlying did nothing, if it just traded sideways, this spread would still make us $7.38 every day that passes, just simply from those contracts decaying, right? So that's perfect. That's what we want. And that is your basic put vertical spread, in which we'd be bullish because we are short this 40/40 strike here. We're long a strike below it for protection. And if the S&P 500, trades anywhere here or trades higher, we make money. Great, perfect. Okay, so that is your put credit spread, and the call credit spread is obviously the inverse of that. Where we are bearish, we might think that this all-time high secure. There's no way the S&P 500 is going to break that all-time high over the next 6 days. That's at 42.36. Let's see what kind of delta we can get up around that area. So we come to our call side here, and we see 42, there's a 42.35, but there's only 11 delta there. So, I like to get closer to a 15 delta, definitely not less than a 10 delta. When you start getting down to a 10 delta, it becomes harder to adjust the trade. So just something to consider. We're not really going to go into adjustments in this video, but if a trade goes against you, a lot of times you can adjust it. And when you start moving really far out on your deltas where you have a really high probability of profit, you also run out of options when it comes to adjusting the trade. So to get closer to a 15 delta, it looks like we'd have to come to the 42.25, which you can see gets us just outside of the expected move. So we're going to be a lot tighter here on the call side, which tells us that there's more of a skew to the downside. The puts are trading more richly, which means that people believe that there's more risk to the downside right now. So because the puts are trading more richly, we can get further away from the current price of the underlying. So that brings us in pretty tight there. If we do that 16 delta, we might just go with a 13 delta if we want to be a little bit safer. Let's throw in our protective leg here. So even at the 13 delta, you can see here that our max profit is $145. Our max loss is $855. Now, the pricing won't always be great. It's the weekend, so when the markets close, the pricing on these won't always be great. So if you start playing around in your platform and setting up trades on the weekend, just understand that the pricing is probably going to be different during market hours and usually less favorable. So that's just the way it works. But here you go. We've structured a call credit spread that is bearish to neutral. So we came in at the 42.30 strike. We shorted that and we went long the 42.40. So we come here and look at this on the chart. Your 42.30 is here. So it's just below the all-time high. So if we put a line here, this is where we're short. So as long as the S&P 500 stays below there or sells off, we make money in this particular case. So that is your call credit spread. So like I said, the takeaway between the two different types of vertical spreads, debit spreads, they're great for strong directional bias moves, but understanding that time decay is really going to work against you, and they're generally harder trades to pull off. Credit spreads are great whenever you have some type of directional bias in mind, but you're not sure on the timing. So they're great ways to make you money as long as you're right on the direction, or at least the passage of time. So that is your two different trades in terms of vertical spreads and how you can set those up in Tastyworks. Now we're going to jump into the different types of strategies that you can use and understand how they are essentially built from a combination of vertical spreads. Okay, so the first strategy that we're going to go over here is an iron condor. And once again, we're going to use the S&P 500 as an example. And an iron condor, essentially all that is a combination of two vertical spreads. Now, you can do a debit iron condor, but most of the time, you're always going to be doing a credit iron condor. A debit iron condor is going to perform very differently, and they're actually very difficult trades to pull off. So the majority of people always do credit iron condors. So that's pretty much all we're going to worry about covering here. So as we know, all of these strategies are going to use a combination of vertical spreads. So in this case, we did call vertical spread up here, right? So we were, say, short the 42.40 call, and then we come in for a protective leg here just above that. So we want the underlying to stay below this spread up here. Now, an iron condor just consists of doing this and then adding in a put side too. So maybe we come in and do a put. We short the 440 puts there. We do a long strike just below that for protection. And now you have basically two vertical spreads, two credit spreads. You have up here, you have a call spread, and down here you have a put spread. And really, I should say you have a call credit spread, and down here you have a puts credit spread. So they're both credit spreads, and it's pretty obvious that what we want the underlying to do is to stay in between our spreads. Anywhere in here, we make money. Okay. So let's take a look at this in Tastyworks, and we'll see how you can set this up. If you're going to put this trade on all at one time, maybe we come in once again and we look at that 6 days to expiration cycle, and we do the same thing. Let's start out by first going to our deltas here on the put side, and let's go to that 15 delta. So we have the 40, let's do the 40.40. Strike there. There's your 15 delta, and then let's come up 2 strikes above it for our protective put there at 40.30, and then we come over here to the call side and look for that 15 delta. We don't have a 15, but we do have that 16, so let's short that one, and let's come in for our protective call leg there, 42.35. And you can actually come over here and click on the curve view, and you can look at this and see on this view, if it helps you out, how this trade is actually going to make money. You can see that the price of the underlying is currently right here as we're putting this trade on. So if the S&P 500 moves higher, if it moves up towards that all-time high, it's going to trade up towards our call leg here. As long as it doesn't go through our entire call leg, then we make money. If it does go through our entire call leg, we can see that we would be facing a max loss of $735 for this particular trade if we held it all the way until expiration. And again, it traded through that entire call leg. Conversely, if it sells off, right, and it comes down here towards our put leg, again, we're fine as long as it doesn't trade through our entire put leg. And you can see how this trade is going to profit and loss based on each day and based at expiration. So this is your profit and loss curve at expiration. And then this is your profit and loss curve in real time. So we're looking at Monday of next week. This is essentially where your profit and loss curve would be. And then as each day passes, you'll see that if I advance to Tuesday, you'll see how this curve in real time is starting to move upwards. We move to Wednesday, we move to Thursday, we move to Friday, and it's fully profitable there. You can see obviously as you move to the day of expiration, this curve here is going to be overlapping with your expiration profit and loss curve. So sometimes it's helpful to see this in this view. And again, some of the other metrics that we look at down here, you see that the theta here in this particular trade is going to be making us $28.42. So every day that passes, we're going to be making $28.42 just simply from the passage of time. If the underlying doesn't move at all, we still make money. The delta on the trade is negative $2.59. So it's pretty much neutral, which is what you want to see on an iron condor. When your delta is close to zero, it means that the underlying is essentially kind of trading near the middle of your spread, right? It's in the middle between your call spread and your put spread. Looking at it on the chart, again, if we have our call spreads up here, our put spreads down here, if the underlying is trading right here in the middle of those two spreads, then you're going to have a neutral delta closer to zero. But if the underlying starts trading up towards your call leg, then your delta is going to start getting skewed away from neutral. Same way if it starts trading lower towards your put leg, it's going to start getting skewed away from neutral, and you're going to obviously start to go red on the trade probably as it starts to test either side of your trade. But it does depend on how much time you have until expiration as to how much you're gonna go red, essentially, if it comes up and tests your call leg or down and tests your put leg. So that's essentially what you're looking at with your delta there. Obviously, you want to see that delta as neutral as possible. That means you're safely in the middle of your iron condor. But as long as it stays in the middle at expiration, you're golden, you make money, you would keep that full $265. Now, you don't, of course, have to hold this to expiration. You can see there is an 89% probability of capturing half of that. So a lot of times you'll go for a 50% capture rate on your iron condors and just look to capture half of this max profit here. There's a really high probability of that happening, right? So it's much better probability of that happening than actually capturing at least 1 penny at expiration, holding it to expiration. But either way, they're both really good probabilities of profit, and they're just a combination of credit spreads that constitutes the iron condor. Okay, so now let's jump into butterfly trades and look at how those are constructed through a combination of vertical spreads. For that, I want to actually jump over to Tesla's chart here. And if we take a look at this technical chart on Tesla, I'll just throw a line on here at this swing high. This was a breakout level here. You can see that Tesla had an all-time high here where it pulled off of, and it consolidated for a couple of months before it rounded back up and then had this huge macro breakout above that swing high, which was at 502.14, essentially your 500 whole number, a big psychological number. So if you were looking at this, you see that Tesla's pulling back and it keeps trying to work its way down to that 500 level. Let's say that you think that next week it's going to finally make the move lower and you want to put on a trade that targets that 500 area where you think Tesla is going to go. Well, one of the trades that you could use for that is a butterfly. So let me show you this. If you come in here and let's say that, let me zoom in a little bit on the charts. So let's say that you come in and again, you're targeting that 500 level. So what you would do is you would come in here to that 500 strike price. And because you're targeting a price that's below the current price of the underlying, Tesla is currently up at 580. You're targeting a level that's below the current price of the underlying. You're going to be using puts in this example. If you were targeting a price above the underlying, you'd use calls, okay? So in this case, we think that it's going to come lower. We're going to target that 500 area. So what we're going to do is come in here and we're going to actually short. We're going to short 2 puts, right there. We're going to short 2 puts at that 500 strike. All right, that's the first thing we're going to do to structure this trade. And this trade's going to be put on at the same time. But this is the first thing we're going to do is structure. We're going to short those 2 puts at the area we're targeting. And then we're going to come out equal distance on both sides of that, and we're going to go long puts. So we come up maybe to that 520 price there, and so we go long 1 put here, and then we come down to the 480 strike here, and then we also go long 1 put down there. Okay, so when you look at this, we're short 2 puts here at the 500 strike, we're long 1 put at the 520 strike, and we're long 1 put at the 480 strike, and that constitutes our butterfly. It's called a butterfly because of the fact that you have 2 shorts contracts in the middle, right? So again, you are short 2 here, and you're long 1 on either side. So the 2 contracts you're short in the middle here, this is the body of the butterfly, and then the 2 long contracts on either side make up the wings of the butterfly. That's why they call it that. And the way this trade is going to make money is if the price of Tesla sells off, right? We want the price of Tesla to sell off, and we would make max profit on this trade if Tesla closed right over our short strikes right here at that 500 strike price. Now, the odds of timing it perfectly where Tesla closes on Friday, the day of expiration, right at $500 is incredibly low, right? So these types of trades have a really low probability of profit, but they're generally super cheap to put on. So they have a really big, or really good risk-reward ratio, but a really low probability of profit. So this is your basic butterfly. And you can see that what this is, essentially, again, if I draw this out, you've got your long put here, your short puts here, and your long put here. What this is two vertical spreads. You have a debit spread here. You have a put debit spread here where you're long a 520 put and you're short a 500 put. Okay, so obviously this spread makes money if the price of the underlying moves down toward it. You also have a credit spread on where you are short 1 put here at 500 and you are long a protective put below it at 480, right? So here is your credit spread. So you have a debit spread and a credit spread combined together to make your butterfly. So as you can see, the vertical spreads are the foundational building blocks for just about every other type of spread you're going to put on. And hopefully this kind of helps you put it together in your mind and understand how these things are structured. All right, so now let's jump into the Tastyworks platform and let's model this trade with Tesla, and I'll show you what this looks like. We'll pull up Tesla. And let's just go, let's say that we're going to target this move for this next week. So generally you're going to put on butterflies with a shorter expiration time because obviously it's going to be a lot harder to be right further out into the future. So we go 6 days out on this one and we come down to our 500 strike price. Here we go. Here's our 500 strike price. So we're going to start out by shorting that 500 strike right there. And let's say we come up to the 490 and we go long there, and then we come up to the 510 and we go long there. Now, what we need to do is highlight the short strike here, and we need to increase that to 2 contracts. So now you can see we are short 2 contracts at the 500 puts, and we are long 490 put and 1 long 510 put. So there's our butterfly. Now let's hop over into our curve view and take a look at this. Let's switch it to Monday. Okay, there we go. And if you look at this, you can see that the price of the underlying is currently here. And the pricing on this is actually not right. It's for a butterfly like this, you're always going to be really putting it on at a debit. But you can see that right now the NAT price on this is 13 cents, right? So the pricing, like I said, in real time, the pricing is going to be very different. But based on this current pricing, it's essentially going to cost us only $13 to put this trade on. So basically nothing to put this trade on. And that is our max loss on the trade. But our max profit is $987. However, our probability of profit is only 4%. So it's incredibly low because we have to be really right on this trade. We need Tesla to really sell off down to 500 where our short puts are here, and we need it to close right there. If Tesla were to close exactly at 500 on the day these contracts expire, we would make max profit. Obviously, that's probably not going to happen. But you can see that as Tesla does sell off, the spread will actually make money, right? As Tesla's selling off, you can see our theoretical P&L there is $78.32, and it keeps increasing and increasing as we get closer to this profitability tent that we have set up here. Now, one thing that we can do is we can widen out the wings on the butterfly. You know, we can come back over here to our table view and maybe go to the 485 and then the 515. So we have essentially wider spreads between our two spreads that we have there. And we come back and look at this, and you can see that our max profit potential is considerably higher. And we can see that obviously if we do it from this view, how it's going to start changing the trade. We have the potential to make more money, but we're also going to be looking at costing more money to put the trade on. As we widen that profitability tent out further and further, it's going to start costing more and more money because the probability of profit on the trade is going to be increasing. So this is your basic butterfly. This is a great way that you can put a trade on. Like I said, you know, if we structured it like this, it would cost $58 to put this trade on with a max profit of $2,442. And you can see that even if we don't expire right over our short strikes here, we're still going to make money. Here's your profit and loss curve here in real time. You see how it comes up like this as it moves toward that profitability tent. So even if Tesla does sell off on Monday, you know, we'd still be up quite a bit. So there's still a way to make money on this trade. But it's generally a lower probability trade that's going to be harder to pull off. And it's especially useful if you're good at technical analysis and targeting specific areas on charts. Okay, so this is your basic butterfly. Now I want to show you how you could set this up as a broken wing butterfly. So when we look at this, you can see that it looks like a butterfly, right? You have the body of the butterfly here, and you have the right wing here, you have the left wing here. Now, what happens if we actually break the butterfly up? So let me come back over here to the table view. Let's go back to the original structure we had here. So here's your perfect butterfly. Again, we'll go to the curve view. What happens if we actually take this side here and we break the wing? If we do that, now look what happens. Now we have a way to make money over here on this side. We have a way to make money right here inside of this tent. Only if it sells off below our tent do we lose money. So a broken wing butterfly is a great way to put on a trade that essentially allows you to make money both neutrally and directionally, similar to a credit spread, because we are essentially looking to collect a credit. Now we can play around with this. Like if we bring this in like that, you can see that we're going to start increasing the amount of money that we could bring in. You know, right here, we're looking at a 36-cent credit. So essentially we would bring in $36 to put this trade on. If we were totally wrong and Tesla actually traded higher, we would get to keep that $36 we brought in on the trade, and everything would just expire worthless, no big deal. If we were right and Tesla does sell off but doesn't make it all the way down to 500, we'd still make money. We'd collect that, we'd keep that full $36 we collected, and we'd still have a profitable trade. And if we were right and Tesla sells off and closes right over our 500 short strikes here, we have a max profit potential of $536. So this trade is a great way to be able to put on a directional bet on a stock without having to worry so much about the timing of it. If it just just takes too long or really doesn't make it as low as you thought, you still make money, right? So you want to be able to structure this where the amount of credit you're bringing in is still worth it. Like if you're wrong on the trade, it's still worth the amount of capital that you're putting out here. You can see our max loss is $964, and we're looking at a $36 profit at least on the trade. So 36 divided by 964. So you're still looking at a 3.7% return on your capital over 6 days. So if you were just completely wrong on the trade and it never sells off, or it just stays where it is, or it even rallies all the way back to all-time high, you still made, you know, a couple percent return on your money at least over 6 days. So that's still nice to be able to structure it that way. So that is an example of a broken wing butterfly, and generally speaking, this is the way I will always structure my broken wing butterflies, is when I can put them on for a credit. Now you can put them on for a debit, but it's generally not something that I'll do. So if you do that, obviously you're going to be changing it up quite a bit. If you do it like this is not what I would be doing. This would be very strange to do it this way, because you're looking at, you know, guaranteed loss over here. You would need the stock to make that move towards your profitability tent, even to make anything. And then if it keeps going lower, you still make something. It's just not the way you would structure it. In this particular case, it just makes more sense to do it as a credit like this. So that is your broken wing butterfly, and it's definitely one of my favorite trades. Let me show you an example of one that I have on. If I go to Amazon here and we go to our curve view, you can see that what I have here is I am short the 2950 puts, and then I'm long a 2800 put, and I'm long a 3000 put. And I actually brought in on this trade a total credit of $55. So I brought in $55 on this particular trade. And you can see that the way this is going to work, if we go and take a look at this next week, so even like Tuesday, right? This is Tuesday next week. What's going to happen is if Amazon does nothing, or it trades higher, then I'm just going to keep that $55 that I collected on the trade. No big deal, and everything expires worthless, and I walk away with $55. If I'm right and Amazon starts to sell off, you can see that our theoretical P&L, here's your theoretical P&L, this brown line. You can see as Amazon sells off, our theoretical P&L starts to climb up, okay? And if we get all the way over here to our max profitability tent right here, we can see that, you know, the most we could make on this trade is about $5,000. Of course, the odds of that happening are very, very slim, but there are ways to make money all the way up to expiration. You don't have to be right exactly inside of this tent. So a really great trade. This is a classic broken wing butterfly, and Amazon is probably one of my favorite vehicles to use for this trade, because you can generally collect a pretty decent credit, and it gives you some directional exposure, but also it gives you the safety of, if you're wrong, at least at least you're still making money here. So the last one that I will just go over is a ratio spread, and this is one that I do less often. But it's essentially like a butterfly without a protective side. So let's take a look at this one here on Netflix. You can see that I am short the 460 puts, and I am long the 475 puts. So we go and take a look at this on the trade view, and as you can see, it looks very similar to our broken wing butterfly, where I collected a credit for the trade. I actually collected a $13 credit. And so if I'm completely wrong and Netflix goes nowhere or trades higher, I keep the $13, no big deal. But if Netflix does start to sell off here, you can see that this trade is going to really expand nicely as it starts moving down here towards our short strikes at 460. Max profit on this trade is right about $3,000. Now the difference here is that I don't have a protective leg over here on this side. Remember, our butterfly involved we have two short strikes here. We have a short strike on this side that makes up our right wing, and then over here we'd have a short strike that makes up our left wing, and then when we break it, we make it that broken wing butterfly. Well, I'm completely missing the wing over here, okay? And so this is the ratio spread. This is where I am short more contracts than I am long, okay? That essentially makes up your ratio spread. And obviously the way this works, you can see that I have two lots on. So essentially you know, I'm short 2 here, long 1 here. So 2 lots means that I'm short 4 here and long 2 here. But obviously you can see that because I am long this 475 put, if Netflix starts to sell off, this 475 put is going to start to appreciate in value, right? It's going to start gaining value because Netflix is going to be selling off and moving closer to that strike price. And the short puts that I have on here, although I am short those puts, as long as Netflix stays above those puts, they'll still make me money. But once it starts to move down through that strike price, you can see how I will start to lose money on this particular trade. So, you know, ideally, I want Netflix to stay above 460, of course, but you can see that structured like this, it gives me some directional exposure. If I'm correct and Netflix starts to sell off, I have plenty of ways to make money. I mean, you can see right here, Tuesday of next week, if Netflix were to sell off all the way down here to 475, theoretically, I'd be up like $700. At expiration, I'd only be up that $13 credit I collected. So the closer you get to expiration, the less the spread will expand. But if you have some time till expiration, in this case, these contracts expire at the end of the following week, you know, it still has a chance for the spread to expand, and I'd be able to actually get out for a profit without having to, you know, get all the way over here to this profitability tent. So essentially a ratio spread it's just like a broken wing butterfly without that protective wing on one side. So that about wraps everything up, guys. It was a rather lengthy video. There's a lot to cover with these types of spreads, you know, the types of strategies that you can use, but I really wanted to emphasize the importance of how everything is really built around vertical spreads. You saw that Iron Condors is just a combination of a call credit spread and a put credit spread. A butterfly is a combination of a debit spread and a credit spread, right? So you combine these vertical spreads together to essentially structure various different option spreads, various different option strategies that, you know, seek to achieve different things depending on what your goal is for the trade. So as always, guys, I really appreciate you watching the video. I hope it was really helpful. Be sure and let me know in the comments below. If you did have any questions, I'm happy to answer those for you. I think it's a great starting point. The platform that I use for structuring these trades was Tastyworks. There is an affiliate link in the description below if you want to support the channel and you're thinking about opening up an account there anyways. Feel free to check out the website through that link. And as always, guys, I do appreciate the support. So have a good one, trade safe, have a green week, and I will see you guys in the next video.